you're not going to get below 3% core CPI. The math just doesn't work. It's just a matter of, are you comfortable with looking through tariff inflation and making these policy adjustments? That's what I think the Fed's going to do. And especially next year when you get a new Fed chairman, they're going to even be more dovish. So from here to 2026, I think you get a lot of cuts.
Warren Pies, founder of 314 Research. It is so wonderful to welcome you to the show. Thank you so much for taking the time to join me today, Warren. Really appreciate it.
Yeah, absolutely. Thank you for having me.
Well, we're thrilled to have you. And I have to give a shout out to the viewers who recommended you. We have the best audience. I always like to say the nicest people on the internet watch this show. And you came as a recommendation when I asked, who should I have on the show in 2025? So absolutely thrilled to have you on. And I was spending the last 45 minutes, Warren, reading your latest research note. And I thought it was incredible because I feel like you really captured what I've been kind of seeing or sensing. You really captured the pulse of what I've been hearing from guests in like the best way possible, this widening perception gap that we are seeing in macro. I want to get into that, but I do want to start, Warren, where we always start with our guest, and this will help folks get to know you and how you think about the world. And that is with your big picture, more of that macro framework, how you're looking at the world, the framework in which you're looking at the world, that big picture when it comes to the economy, markets. So let's start there with that framework. And one of the things about this show, Warren, is you can take all the time you need to set the table when it comes to that big picture view.
Oh, wow. Okay. The big picture view, I'll try not to just go on and on. I'd say, so thematically, our view is that the world is transitioning from what we call a deflationary mindset to a debasement mindset. And this has been going on since the pandemic. It's something we've been writing about for a while. And just to understand what that transition looks like, a deflation mindset is what ruled markets in our view post GFC. And so GFC, it was all about debt deflation. Protecting principal was the most important psychic concern coming out of the GFC for investors. And so that was reflected in the way assets were priced and a whole other host of other things. In our view, the pandemic was really ended that era. And we've now entered into this debasement era. And the debasement era is characterized by a whole host of behavioral changes amongst investors. And I think it's really becoming prevalent out there. People are starting to see this. We've been talking about how, hey, more or less the thing that's going to the big psychic concern now as we go through these years is going to be keeping up with maintaining purchasing power. And anyone who's tried to buy a home or a car over these last few years, I'm sure feels it. As long as money has some scarcity value to you, then you're feeling it. You know, everything's leveled up post pandemic. We think that really came from fiscal. I know there's a lot of anger with the Fed. The Fed they've made their mistakes, but I think that if you're really mad at the Fed, you should probably redirect your anger at the fiscal authorities and how really the post-pandemic period they've navigated it. So that's our big picture view. And in that world, you're more or less, you're structurally bullish on equities and bullish on hard assets in general. I think that the blob of liquidity moves incrementally into different areas of the asset menu, but we've been bullish on gold. And, Bitcoin's one of those things where we're strange because we don't really have a strong opinion. Like our main fund and model, we have like a 3% max position Bitcoin, and we've been riding that max position through the last couple of years. And so it's reflected. These are debasement assets. And I think that's what's going on. Now, when you think about the macro economy, there's a secular picture and there's a cyclical picture. And I think time frames confuse people a lot when we're talking about things. I could be talking about what happens next week. I could be talking about what happens next month, or I could be talking about what happens over the next decade. And every one of those things is going to be really different, And so the long term we call secular. That's like a multi-year view, and that's the debasement mindset that's coming in. We're in year 5 of that. I think that you have another 10 years potentially in that change. But on the cyclical basis, our view before the tariff and Liberation Day was that inflation was actually troughing this year. Even though we think in this debasement world, inflation will be structurally higher, we thought that there's this 12 to 18, 24 month period where inflation could be subdued just because of the way you measure it in the CPI. And so those are the big picture factors, just to set the table.
I love that. Okay, this is so fascinating to me. Talking about going from this deflationary mindset era to this debasement era that we're in. We're about 5 years into it. I can't believe it's already 2025. It feels like it was just yesterday. It was 2020, and it makes me wonder, Warren, the behavior changes among investors. That I wonder if we're still early in the recognition of this new era. Do you think folks have really caught on, or do you think some people might still have this kind of older mindset of like how things used to be?
I think we're right in the middle of the transition. And I think, this last sell-off, though, I believe really advanced this transition a lot. So, a lot of this is you have to study the behavior of markets to understand what the psychology out there is. And I think that the sell-off we had, and then the fact that retail, by all accounts, set the bottom in that sell-off. And like I could say anecdotally, like I would go to my son's football games on Friday nights, and you meet other parents and they know I do this for a living. And so they all kind of huddle up next to you. Hey, what's going on with the markets? And it wasn't too far into April where the parents would say things like, well, I wish I would have bought more. I wish I would have bought more Palantir. I wish I would have bought more Bitcoin. I wish I would have bought that. So the risk appetite was strong. They've been trained to buy the dips. And so to me, that was a good reflection. I mean, anecdotes, we're a quantitative, for anyone who doesn't know us, we're very much a quantitative macro shop. And so, but obviously, these anecdotes inform the data. They show you what you see in the data, and we did that during the sell-off. We looked at where was the buying coming from, and we saw retail set the bottom. We saw corporates set the bottom, and then you saw systematic funds like vol target funds and CTAs pile in and advance that rally. And the group that got left out to dry were a lot of these traditional Wall Street strategists and banks and players that expected this to be a more protracted downturn. So I think we're in the middle of it. I think there's still more converts. So, by the time everyone gets into this, debasement mindset, we'll be late in the game. And this is a multi-year process. Everything's is going to take time, and you have to convert all these people and pull them out of their debt deflation mindset.
Yeah, I love the anecdotes, and it's so true. I remember the group text I was on with friends during that time around what folks were buying was it was entertaining. It was interesting. Okay, I want to explore this idea that you brought up because you're pointing out if you're mad at the Fed, you should really direct that toward the fiscal authorities. I thought that was so interesting. I would love for you to elaborate a bit more because it seems like fiscal's really been driving a lot of things. So I'd love to hear more there.
Yeah, we've been talking about the fiscal dominance theory. I think sometimes the phrase gets misused. It doesn't really, I don't feel like you need to be technically correct to understand the real, the main consequences that we're talking about here. And it's just that we started running structurally these pro-cyclical deficits that were larger than any time post World War II in the history of the United States. So say 7% of GDP deficits when unemployment rate's at 4%. You can put together a scatter plot of those two variables and you just do not see this. So when I say pro-cyclical, I mean that we're running a recession-like sized deficit when we're at the peak of expansion. And that's what that is it's basically stimulating in the highest power type of money to send out into the economy. Fiscal stimulus, fiscal deficit spending is like direct payments out into the economy. There is no lending channel you have to work through or anything else. It goes straight out in a number of different ways, and it's high powered. And I think it was the thing that tripped so many people up. It's why we didn't have a recession in 2022 or 2023, even though that was the consensus call. And everyone was really has underestimated. I think even us, and we've been saying for a long time, we would pull up the checkable deposits charts where it went from it just ballooned overnight, basically because of the pandemic and the amount of fiscal spending. And we would say, we don't really know how to factor this into our models, but this is crazy. And it might put us in a totally different world than we've been in before economically. And so to me, that's the dominant factor. There's a lot of anger at the Fed. Oh, you're going to move interest rates up or down. I mean, they raised rates 550 basis points in 2022 and more or less didn't impact the economy too much. I mean, there's a whole bunch of people who say, well, they should have used the balance sheet. They should have done this. They should have done that. And like, those people are generally disconnected from reality, in my view, because the Fed is not going to proactively crash the economy. And so to me, there's a whole school of thinking that has ascribed way too much responsibility to the Fed for how the economic conditions that we're in. And even now, like, we had the whole Jerome Powell, Jackson Hole speech here recently, and there's a lot of anger about the dovishness, basically him more or less codifying a September cut in that speech. And I see a lot of frustration and anger. In my view, is that the frustration and anger, is really more about what happened in those pandemic years and what happened from the fiscal authorities. And this 25 basis point cut, it's really going to be inconsequential in the grand scheme of things. And the die has already been cast. We've already changed the entire paradigm of this economy through that fiscal response. And so that's what I mean by that.
Interesting. So let's talk about the Jackson Hole speech, because I know everyone had been so focused on that last week. I had Jim Bianco on the program on Friday afterward and aired as a Saturday special. And he thinks that a cut will actually be a policy mistake. But I just want to kind of get your view of the Jackson Hole speech. And what I'm kind of hearing is if they cut 25 basis points, it'll be inconsequential. But so my question is, does the Fed really matter then if it's the fiscal side driving things? Just want to hear, how are you thinking more about the Fed?
Yeah, I'm trying to divide two things. So there's this feelings of frustration. I think there's like the anger at the Fed, that emotion is about things that have already happened, in my estimation, that can't be changed, really. And that's on the fiscal authority from the way I read the situation. Now, when we go forward, you can't change what's already happened. Like, house prices have gone up 50% and they're not coming down. They're not crashing. That's money that came out and went into this area of the economy. Same with the stock market. We're not going back to this like 2019 trend line. We're not going back to the 2019 trend line on any of these assets. Like, we've broken that trend line because of the amount of money that's gone in the system. So I think you have to get back to that cyclical discussion. We have we're in a secular debasement regime, but I think on a cyclical basis, outside of tariffs, you have inflation is mostly troughing and disinflating. It's really about housing inflation is down 90 basis points year over year so far year to date. And I think there's more of that to come. Oil's down 12% year to date. I don't see a big oil rally in our future. And that was my background, was in the oil and gas space. So I know I hear Jim's argument and a lot of those arguments, which is that the labor market is actually tight now because we've had so much supply cut off through immigration policy. But, that's not reflected in wages. So if you really had a tightening labor market or a static labor market, you would see wage growth starting to kind of stall out here. And we're at new cycle lows in wage growth. So when I see what I call that as a loosening labor market, a disinflating housing market, and weak oil prices, those are the three main vectors that inflation comes through. So I don't see. Now, tariff inflation is going to do what it's going to do regardless of the Fed. And that's why the Fed goes back to 2018 Teal Book and says, hey, we should look through tariffs because it's basically a one-time price increase and all that. Nobody has patience to hear that after what we went through post-pandemic. But that's the truth if you just analyze this situation. So what I look at is the inflation picture, to me, outside of tariffs, is not concerning in the near term. So it means to me that rates are restrictive. And when you, the other side of rates being restrictive is when you look at the labor market and the economy, the labor market is loosening in my view. that July jobs report was pretty weak. We saw the unemployment rate tick up. We saw the hiring rate tick down. The firing rate is now above the hiring rate for the first time this cycle post-pandemic. So what that means is that there's a freeze in hiring, and now you're starting to see a tick up in layoffs. Continuing claims are not at recessionary levels yet, but they keep bleeding higher. And then you see wage growth, which is reflecting that loosening in the labor market coming down. So wages from the Atlanta Fed wage tracker, close to 4%. That's a cycle low. You go to Indeed, the private job tracking company, and they're at a cycle low of 2.4%. So you look at both of those metrics and map that onto what's happening in those labor reports. I think that the labor supply thing has really messed up a lot of analysis. It's caused a lot of confusion. It did it last year too. Last year when we saw the unemployment rate come up because of so much immigration and labor supply, we said this is not a recessionary signal. This is not a growth concern. We called that a benign loosening. I think that was like a pretty, we were clever with that. This time around, we're calling this current stalling out of the unemployment rate a malignant stasis, which is probably not going to stick in the same way. But it's just to say that supply factor is what's swinging around and causing some confusion in the data here and now. But the bottom line on all that is I understand the inflation argument, but I think that the labor side of the equation is much weaker, much more straightforward here. So the Fed should be cutting. They're restrictive and they should be lowering interest rates.
Okay. And then I think from your note, and you may have said it just now too, but if we held the labor force participation rate constant from April, unemployment would be 4.9% instead of 4.2%, correct?
Yep, right? That points again to this idea that what you're seeing is a tightening of supply. And everyone sees that or talks about that. It's just a matter of what does that mean and how do you interpret it? So there's really these two big policy factors. You have tariffs, which are pushing up cost in the goods side of the basket. And then you have immigration, which is kind of skewing some of these numbers on the employment side. And that's why I think we talked at the beginning, you brought up the perception gap, the widening perception gap, which is what the title of our report was. And that's why, because there's these policy clouds that are causing a lot of making analysis kind of problematic for many people.
Yeah. Okay. So on the labor side, we're calling it the malignant stasis.
If you want to. It's a little bit, we'll see how well that one does. But yeah.
I want to bring up something with inflation with you just to explore a bit more. As you're pointing out, like we have oil down, shelter cooling, wages decelerating. But I guess my question is, core CPI won't budge below 3%. So what's driving the stickiness?
Yeah, that's what we wanted to do, because we've been pretty, we came in here as, I would say, we expected this cyclical disinflation, and we've gone on core CPI from 3.25 down to 3.05. So we have had disinflation, but admittedly, it hasn't been as strong as we would have expected. So what's going on? What's happening in the inflation picture that was a little stickier than we expected coming this year? Well, number one is tariffs. So the real recipe for getting us down to close to 2% CPI target, and I know it's PCE, but just stick with me on the CPI thing, because that's what we have more data for CPI to talk about. So core CPI over the pre-pandemic years, we got to that low twos by having a 2.5% to 3% oscillating super core. So that services non-shelter, and then shelter, 2.5% to 3%, sometimes around 3% for super core. And then we had goods outright deflation. So goods were down year over year on average, like 30 basis points back then. When you put all that together, you get close to the 2% target that the Fed had. And you probably adjust for the PCE weightings and you get down to 2%. So that's that was the recipe for many years to get us there. And now we're in this world where with tariffs, you're not getting that goods deflation. You're going to get goods inflation. So the math doesn't work unless you can pull supercore or shelter down below where they were pre-pandemic. I just don't think that's going to happen. So it really comes down to, we're not probably going to break down below 3% in any meaningful way on core CPI. So that is the dilemma, is like, how is the Fed going to handle the optics of that, of cutting into that? And there is already a lot of consternation. You have the Trump administration that's putting political pressure on them to cut. And then you're going to have a lot of people who are just somewhat rightfully frustrated that the Fed is not abiding by their mandate. And so, if they don't believe in the look through tariffs argument, then they're going to be very angry with the Fed for cutting above 3% core CPI. So that's what's really sticking. And then, when you zoom in, there's a few things that are one-offs. And this is what gives us, I think this is what the Fed's going to pull out and use when they decide to cut. And they'll probably cut with core CPI above 3%, is medical services. That was a big pressure on the July Supercore number, which was high. You had transportation services in the same boat. Both those had the largest seasonal adjustment that we've ever seen in a July on record. And that's not a small thing. It's like 20 basis points month over month getting added to the Supercore number there. So I think there's going to be some mean reversion in that area. And then there's structural things like electricity, which is basically is going up in the CPI, and net electricity generation is making new records in the United States because of this data center build out. So there are some structural things that are inflationary, but again, electricity is like 2% of CPI ultimately. I get a lot of people who worry about that. And the big pass-throughs from some of these auctions that have been taking place probably won't hit the consumer basket until middle of next year. So when I put all that together, I think you're going to have with goods being at 1.5% to 2% year over year, and potentially even higher depending on how these tariffs shake out. You're not going to get below 3% core CPI. The math just doesn't work. It's just a matter of, are you comfortable with looking through tariff inflation and making these policy adjustments? That's what I think the Fed's going to do. So it's probably we really usually don't give normative statements like, hey, what should the Fed do? If you put a gun to my head, I'd probably say, that they should probably look through tariff inflation given what's happening in the labor market. But I understand if you don't like that viewpoint. But the bottom line is that's what they're going to do. That's what they're going to do. And especially next year when you get a new Fed chairman, they're going to even be more dovish. So from here to 2026, I think you get a lot of cuts.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. Okay, I want to talk about this widening perception gap, because even like with the Fed too, there are differing views within the Fed on what we should do as well. So, but when I think about the markets and the economy, the participants, especially like in the macro world, it does often feel like we're looking at just two different economies, depending on like who's looking at the data. Maybe there's a political bent that comes into it as well. I'll let you flesh out what you mean by the perception gap. But sometimes folks ask me, Warren, they'll say, oh, do you only invite bears on this show? No, that's so not true. We actually don't always know like what our guest views are going to be. So I didn't know, like, other than reading your note, I didn't know what your views were going to be exactly. But I am maybe macro folks tend to be more of a bearish bit. I don't really know, but you would know better than I would. But let's explore this widening perception gap, because I really think you have a pulse on what's happening out there.
Yeah, well, number one, I do think everyone brings a bias to the table when they think about making these kinds of calls. And then like you have all this data to choose from. Like we say macro is the synthesis of chaos a lot of times. You're just trying to take all this chaos and like make sense out of it. And so a big part of that is knowing what to pull out and what to look at, and having a source of truth and having a structure and a model to filter this data through. And I think that helps you avoid being I mean, everyone, including myself, is going to have some bias that you have to work against. Just acknowledge it, admit it, try and argue against your position, try and really see where you could be wrong, because a big part of this is being wrong. And that's a hard set of skills to really foster. And then you throw in the political aspect. I think the political aspect has kind of broken people's brains a little bit here. Like, it's very hard to maintain a disinterested disposition when it comes to Trump, is what I find. Some people love him and some people hate him. I genuinely don't care too much. And I know, like, that probably pisses both sides off. Like, some people think he's the best president ever, and some people think he's like America's Hitler. And to me, I just look at it and try my best to, like, take what's happening. There'll be some good, there'll be some bad, analyze it, and without some emotional attachment to it. But there's definitely a political element. I mean, what I see on the Fed is a lot of former hawks who've become 180-degree doves with no real data to back them up for their pivot from, like, last year. And then you see a lot of the doves, and they're usually more, the liberal academic types, and they can hide their bias a little bit better, but it's there as well if you look close. And they've become very circumspect. They were cutting a lot last year, and now, well, I don't know, cutting might, we might lose credibility, or inflation expectations might become unanchored. But when you dig under the surface, I think both sides are being controlled by their bias mostly. So for us, we really try to go back to the data. What does the data say? We lay out a bunch of things beforehand to our clients and say, this is what we're going to watch. We're going to watch. We think if there's going to be loosening in the labor market, it's going to start in the housing construction segment of the market, for instance. So we model all that out. What's happening in housing? Also, if rates are restrictive, which is what a lot of this conversation comes down to, you see it first in the housing market. So to us, everything flows down from that, and then we can construct our views for macro around that. And that's just an example of how I think you need to have a structure to filter the data from. Otherwise, you become stuck in your bias. You can't change your mind, and you become part of just this, like, mob mentality. So that's what I see going on in the perception gap.
I want to get your take on housing. I am one of those millennials that would love to buy a house right now, but I'm also waiting. And I don't even know if that's the right move. I am waiting because they are quite high, the prices. I am personally seeing things that aren't moving on the market, and I am noticing some prices coming down. We do have Melody Wright coming on the show this week, and she's going to talk all about housing, but I just want to get your views on, like, what's going on in housing from where you sit.
Yeah, well, first off, we look at it more from, like, a GDP perspective first, and that is to say, we think that residential construction employment leads overall job losses. So before each recession, you get to about an 8 to 10% drawdown in residential construction employment. We've now had, based on revised data, 4 straight reports where residential construction employment has fallen. It's a tiny amount each month, but it's bleeding lower at this point. And then what we do is we take starts, completions, time to complete a home. We take labor intensity of single family and multifamily, put that in a big model, and we say, okay, how many jobs do we need in the United States for housing construction? And we're about 90,000 out of about 1 million workers. Then you have trades and stuff on top of that. But just the core group that we look at, there's about 1 million people just under working in that cohort. And we think there's about 90,000 too many. So if you were to get to that place, then you would be firmly in recessionary territory for the economy. Now, there's a whole bunch of reasons we don't expect that to just stair step lower, because I think there is a labor shortage. There is labor hoarding. Builders have fat margins. They're able to pay down. They're able to extend this cycle because of all that. So we have all this stuff, and we look at it through a GDP lens. Should you buy a house? Should you wait? Is there going to be a correction in house prices? I'm a millennial too, an older millennial, but I had the same decision back in 2022, 2023, moving into a larger house. We wanted to move into a larger house. And I think it was part of that debasement mindset. Like, going through that process, to me, it made me realize, like, those old home prices are never coming back. They're never coming back. I don't think there's going to be a big crash. I think Melody, I'm vaguely familiar with her work. I just know that she seems to be pretty bearish. I wouldn't share that view. I think that you are going to stagnate here for many years and you're going to have incomes catch up with housing. But I think we underbuilt housing in this country for a long time. And there's now a supply shortage and there's this demographic bulge of millennials who are just about, call it 37 to 44.
That's
45.
right. I'm 37.
Right.
Yeah.
Okay. So
Yep.
everybody wants to buy a home. That's when family
Exactly.
formation, and everyone in this group has delayed family formation as long as they can, or they've worked with what they could, and now they've got to buy a home. So I think there's a lot of, I don't think the demographics support it. I think that the amount of money we've printed ultimately through fiscal policy that we talked about has leveled up these homes. And
Direct
so
your frustration at the fiscal side then. Yeah.
Exactly. I think that's what I'm talking, because
Yeah.
it is frustrating. Like, how do you make these payments work? And then you get mad at the rich boomers who are giving their kids money and just letting them, using that as a down payment. Like, there's a lot of disinflation creates a lot of angst out there.
Yeah. This is why I love this show so much, because you do get differing viewpoints and you can have different conversations. And I love that. Okay. I want to explore markets with you, because at the top of the show, you're talking about being bullish on equities, favoring hard assets like gold. So let's kind of start with the markets. I just want to get your take on where we are in the markets, the valuations. They make sense for you, because I'm sensing you're still very much bullish on equities. Just kind of, and maybe weigh in on the sentiment as well. Let's just kind of start big picture markets and let's focus on equities to start.
In this world, with this debasement world, one of the things we've said is that unless the Fed is tightening or we see a recession in our models, you cannot be underweight equities. So that's a rule of thumb for our institutional clients. We had a 6,800 price target on the S&P 500 coming into this year. We never changed that or backed away. Part of our call coming in this year is we did expect to see a 10% or greater correction in late Q1, early Q2. So that played out. We were overweight equities, downgraded them in February to benchmark weight, then got back in May, and then to overweight. And now we're back benchmark weight. And so I'd say we're structurally bullish on the equity market, but in the near term, and we've been wrong, we downgraded too early, just to be straight honest about it, is what it is. But I think you have to weigh the odds. And again, we're not outright bearish, just saying reduce your risk if you're a client of ours. And the reason you say reduce risk here is we do see excessive optimism in the near term. I think that there's been, like I referenced, some systematic bids that have really been under this market since the April lows. We had corporate buybacks hit 8% of daily volume back in April. That's something we watch. And if you go play that out on a seasonal basis, we're in a real dry zone for corporations. They're not going to be buying back stocks. So that supports out of the market. Vol targeted funds, which buy the stock market when volatility goes down, those stocks were huge buyers from like late April going forward. That was the next phase of buying, along with retail and corporates. And they're full of stock at this point. And then the next group that came on to the rally were CTAs. CTAs are trend followers, and they were buying more in like late May into June. And they're basically full now. So when I look at it, I think that's a support that's gone for the market. The Jackson Hole thing makes me slightly less concerned. I was more concerned before that, and more concerned that we would probably need to have a little bit of wobble here in this seasonally weak period for the markets before Powell and the Fed blessed another set of rate cuts, but they were pretty dovish. And so maybe I'm wrong on that, and we just hang out at benchmark weight for a while. But when I zoom out, that's the way we're positioned right now, is benchmark equities. We actually are overweight fixed income right here, overweight bonds in duration.
And where do you want to be on the curve then for bonds?
We make our allocation really simple for our clients. Like on this, the way our official allocations get tracked and our performance is tracked, we just use the 10-year as a benchmark so that clients can know, because they can buy spread product if we don't think we're in recession and things like that. And we have a master fund that goes into spread product, and we're overweight spread product in that. We're overweight equities in that, slightly overweight. So it's close to benchmark. And then we have Bitcoin and gold. So anyways, I do think that rates are coming down. Like I know Jim's view, I've talked with him online. I've had discussions with him. Jim's view is that rates went up last year on the long end at the 10-year, for instance, when the Fed cut, and that signaled a policy mistake. That's not my interpretation of what happened. My interpretation is that there had never been a cut cycle that started with the yield curve as inverted as it was last year. The yield curve in the bond market was seized up expecting a recession. So once the Fed came in and supported, and then the data came in and was supportive as well, what happened is that recession pricing came out of the longer end of the yield curve. We're not situated like that now. Like last year, the 10-year was at 3.6 or 7%, and the Fed funds rate was at 5.5%. Today, you're at 4.5% Fed funds rate, and you're at 4.3% 10-year. You have a 3.7% 2-year and a 4.3% 10-year. You have a normalized yield curve here. So what happens in a normalized yield curve historically when the Fed cuts is that you get like a 17 basis point decline for every 25 basis point decline in the Fed funds rate in the 2-year, and you get a 10% decline in the 10-year, and then you get a bull steepening of that 2s10s yield curve by like 7 basis points. That's your historic mapping. I would actually expect to see the 10-year be less reactive because of all these fiscal dynamics and supply and things like that are out there. But nonetheless, I think yields are coming down. Like the big picture is the Fed's going to cut and yields are going to come down. And that's how we're playing it right now. And the other side of that is our worry we have a benchmark weight equity position. Our worry, if you're looking at portfolio construction, is on the growth side because of the labor market.
The labor market deterioration. Yes.
Right.
Okay.
So you get another bad labor report, bonds are going to get a strong bid.
Okay. Got it. And so you're still long equities, but on the benchmark long equities, not overweight.
Yeah. That's for now. Like we've been on and off this year, we've been overweight in benchmark, but never underweight. And we wouldn't be underweight until we saw a recession.
Awesome. This is so great. And it's so helpful. Okay. Another area I want to bring up with you, and we are not a gold channel, but there is a lot of interest in our audience in gold. So you mentioned that at the top. What's your take on gold? How are you thinking about that as an allocation? And where do you see things headed for the precious metal?
Yeah, we've been very bullish on gold for a couple of years now. We thought that when we saw a breakout first, like 2 years ago, in an equal weighted basket of gold. And then what we saw last year was gold breaking out despite real rates rising, despite the dollar rising. You've never seen a calendar year where that happened. And so we thought gold would hit the $3,500 an ounce this year, and we did it. We hit the target. We touched it. I think that it's now kind of consolidating. That consolidation is going to probably last a bit. You need to see the dollar start to re-weaken, I think, to push that next leg of gold higher. And so I think that really is going to require more cuts to come into like the SOFR curve, for instance, than that are already in there right now. So you're probably going to need another cutting impulse to get into the market to then kind of get this dollar index to break down below its kind of where it's kind of found support here, and that would push gold up. So I still like gold. I think you need to have it in your portfolio and be long gold when you're in this debasement world. I think for the rest of the year, you're going to chop probably. And then with a breakout. So watch the charts for that breakout, watch the dollar as well to signal that. And so that's how, but we like gold. We've been big, wouldn't call us gold bugs, but for the last 2 years, we've had some pretty insane gold predictions that have worked out.
Nice. And then on Bitcoin, you mentioned like a 3% allocation in Bitcoin.
Yeah, so that's in our model in our fund, just because our philosophy in that is we have like 20 assets. We have gold miners, we have gold, we have Bitcoin, we have energy stocks broken out as an alternative. We have commodities, crude oil, all separated because our view is that this blob of liquidity is going to move into these different assets at different times. So you want to have availability in your structure. And our model has like Bitcoin, 3% is our max position because we're not crazy about this crypto stuff. And some of the momentum has stalled out. But again, I think that there is this, our theory on it is that you're in this debasement world. It's a lot like gold ultimately when you strip everything away and what Bitcoin serves, what the place it serves in a portfolio. And I do think you're undergoing some level of just mass adoption where you're seeing advisors and other kind of mainstream people take through these ETFs and stuff like that and put Bitcoin into their clients' long-term allocations. And so you just want to stay generally long Bitcoin.
Okay, one final question for you, and it's going to be a two-part question I've been asking a lot of my guests lately. What is that risk for you right now that's maybe keeping you up at night that, or not, doesn't have to actually be keeping you up at night, but that you're thinking about? And what is something that is making you optimistic?
Oh, the optimism is my partner. I'm not a computer scientist by trade or anything. We code a lot for our company, but my partner is, and his background is in AI and machine learning, and he really has converted me. I'm a believer that AI is going to be a big deal for the economy. It's going to be a major productivity boost. I think that the next phase of the AI story is it's going to move into these really high quality, large cap companies. And you're going to see, like you heard, even Walmart, there's whispers that they're going to hold their head count constant for like the next 5 years. They're going to like add 150 billion in revenue and then hold their head count constant. I think that all comes down to some of this AI and automation story that's starting to bubble under the surface. So and you asked me about valuations. We've done a lot of work on valuations, and the bottom line on that is we're not concerned about valuations in this market right here. And I know that makes people really mad when you say that. You sound so cavalier, but there's a lot of research behind that. That's another show at another time. But
no, I love that though, Warren, because we need to have that conversation too. We have to have different views.
Yeah, no, I mean, look, it held me back for a little while. Like last year, we undertook a big project to understand valuations. Is there a way we could see how what this market's pricing that makes sense, that's not a bubble? And we wrote a report. We did all that research. We published it, wrote a report last year, and basically said we think that the market can hit 7,000 by 2026 and not be overvalued. Like that was the big takeaway, is that we thought if you gave us that earnings growth that was baked in, and you give us the margin growth, because margins are a huge factor in all of our research. If you give us those two things, then we think that the S&P 500 will easily hit 7,000 by 2026. And so we wrote a report, S&P 7,000, and some people loved the report. Some people hated it. There had never been more of a lightning rod of a report that we wrote at our company. But I really feel that research has stood up well in this cycle. And so I know it's maybe non-consensus, but we believe that. So yeah, that's my optimistic side. What keeps me up at night? Nothing really is keeping me up at night in the markets. But when I try and think of how this cycle is going to end, we just talked about Bitcoin. I really worry about this MicroStrategy sort of game that's being played, that someday somehow like that keeps becoming a larger and larger piece of the financial infrastructure, and there's more people tied to it. One of the things that was great about Bitcoin for many years when you test it as a quant is it could decline by 80% and it wouldn't hurt the rest of your assets. So it was really uncorrelated in a lot of ways. So it was non-systemic. And now you're seeing crypto, Bitcoin on itself is a $2 trillion market cap, I believe, or crypto maybe in general. It's enough people are using it as a way for the wealth effect, and using it in their economic lives, that if you got a collapse in Bitcoin again, I think it would be a major negative. It would be systemic at this point. It would bleed into other asset classes. It would bleed into the equity market. All that retail bid that we saw by the markets could dry up. So that, if you made me think about how the cycle ends, or a potential doomsday scenario, that's one of them.
Yeah. I have to say, Warren, I've really enjoyed this conversation. I've loved having you on this show, and I'm really grateful for my viewers who recommended you, because it's always a treat to find someone new and get to learn from them and listen to them. And before I let you go, would you mind taking the final few minutes here? Let folks know more about the work that you're doing at 314 Research, how they can support that work, if there's a way to subscribe or access the work, anything that you would like to plug, where they can find you or follow you on social, things like that, and any parting thoughts, anything that you would like to share with this audience. The floor is all yours.
Wow, I appreciate that. And that has been a fun conversation, flew by. I would say you can find us at 314research.com. That's our site. We're an institutional research provider, so we really work with institutions, including advisors, but family offices, hedge funds, advisors, institutional asset allocators. The if you're interested in investing with us, I'd say our main ETF is the Real Asset Allocation Model, or Real Asset Allocation Fund, ticker symbol RAA, and that's that 20 asset model that I was referencing that goes around in all these different corners of the universe in this debasement world and tries to shift around and give you an efficient allocation to the widest set of assets, the most favorable trends. So RAA is another way you can find us. And then you can find me on Twitter at Warren Pies.
I love it. Warren Pies, founder of 314 Research. Thank you so much for being so generous with your time, all of your knowledge, your wisdom, helping us all learn and get better. I really, really enjoyed the conversation today. Appreciate you taking the time and would love to welcome you back on the show at a later date. Thanks again, Warren.
Anytime. Thank you.